Today we're in our office and we have the lovely Nick here with us from NJW Financial. Nick has over 20 years experience in the financial services industry and he has kindly come in today to discuss all things mortgages with us. Nick, would you like to tell us a little bit about yourself?
I'm the Managing Director of NJW Financial Limited, and we are a fully independent mortgage and protection advisory firm servicing Northern Ireland and Central Belt of Scotland.
So we had a few people submit their questions on Instagram to us, so I've got these in no particular order, Nick, and I'll just get started. I guess the biggest one that most people are probably asking is, given the recent economic uncertainty and rise in interest rates, is it any more difficult to get a mortgage now?
Well, it's not actually any more difficult than it was before. Processes are still the same. Mortgages obviously are more expensive now because of the interest rate rises, but with adequate planning and proper study up front, you're going to be able to find out exactly what you can afford and then put yourself in the best position to be approved.
So how would I determine the best mortgage option for my needs?
Very simply, seek out an independent mortgage advisor who will be able to work with you, understand your own current needs and your future plans, and then help design a solution around that for you.
This is probably quite a big common question that we get asked. What's the difference between a fixed rate and a variable rate mortgage?
Okay, so fixed rate's dead easy. It's fixed for a period of time within your mortgage term. So for example, a 5-year fixed rate means that no matter what the Bank of England interest rate does, your mortgage rate will never change, which means your monthly payments will never change. A variable rate is what it sounds. It is variable and it can fluctuate, and most commonly they are shown through tracker mortgages, and a tracker mortgage tracks the Bank of England base rate. So if it goes up, your rate goes up. If it goes down, yours goes down. A discounted variable rate mortgage is where a lender offers you a discount off their variable rate, which is essentially their in-house lending rate of interest. And again, that's subject to fluctuation. There are certain people, certain scenarios where they're perfectly useful. But if somebody's looking for certainty and help with their budgeting, then fixed rate's generally the one that's top of the pile.
And your fixed rate, that can change the term time, can't it? It could be 2 years, 5
Absolutely.
years.
Yep. Standard are really 2 years, 3 years, 5 years. But some lenders are offering very, very compelling 10-year deals at the moment, which I think a lot of people are going to pay more attention to.
Yeah, okay. And how much of a deposit will I need?
Deposit question, you put down as much as you can. The more you own of the property on day one and the less you borrow obviously benefits you. You can work with a 5% deposit. There are some options out there. It is a small pond to fish in when it comes to mortgages. So, if somebody was asking me my advice, I'd say, look, try and get to 10% deposit if you can. It would just give us a bigger range of lenders to work with and a bigger range of solutions.
And does that differ if I'm looking at a buy-to-let mortgage?
It does markedly differ.
Yeah.
Buy-to-let mortgages traditionally are offered at 75% loan to value or purchase price, whichever is the lower. So if we say a home report at £200,000 and it's agreed at £200,000, then the maximum loan to value there is going to be 75%. You've got to come up with the 25% yourself. However, it is 75% loan to value subject to rental income. And what I mean by that is a lender is more concerned about the rental income that a property can generate, because obviously it's going to be that we want to pay the mortgage. We don't want you to be paying the mortgage as the borrower. So it's always wise to get a calculation done before you actually look at a property, because it's not just as straightforward as a straightforward 25% deposit every time.
Right, okay. So can I get pre-approved for a mortgage?
Definitely, and we'd always encourage everybody to get mortgage ready. It's a phrase that we hear all the time, but it's actually a really, really important process, especially if you're looking to bid on a property that there's a lot of interest in. If you're able to show that you are ready to go, you're already being pre-approved by ABC Bank Limited, then an estate agent is more likely to take your offer seriously on day one. Just a quick note on that, what does that mean? People will hear decision in principle and acceptance in principle. It is a cursory credit search by a lender, and the answer is given based on the information that's submitted. So it's not a fully underwritten mortgage offer. But if we can pass that step, we're obviously sort of halfway through that initial process already.
Yeah.
Then it'll go to manual underwriting, which is where the lenders will actually use human beings as opposed to computers to make decisions. So, getting to that stage is vital for anybody wanting to get into the market.
Okay, that's useful. So what kind of documents would I need to provide for the mortgage application?
Quite straightforward. If you're employed, you will need 3 months pay slips and 3 months bank statements for all accounts held in your name. We'll need proof of deposit if the deposit funds aren't held within that bank account. If it's in an ISA, for example, we need an ISA statement. If you're self-employed, typically we look to see if we can get 3 years tax calculations and tax year overviews. Generally, the accountant can pull those together very quickly. In certain types of self-employment, if the business is seasonal, for example, we'd also look for business bank statements just to further support the case we're making for a lender. Aside from that, they're really the core documents, but it's so important to have them on day one all together, and that's, again, part of being mortgage ready. Another thing that we ask, it's our company policy, is that everybody gets themselves an up-to-date report from one of the major credit bureaus. Okay. So we can see what the lender sees on day one. We know exactly how much is owed, what the monthly payments are, what the terms are. It just can save an awful lot of time if that's all done up front.
Okay. And you mentioned self-employed. We've had someone who has said they're self-employed. Does it make it harder for me to get a mortgage?
Definitely not. It's no harder than it is for an employed person.
Okay.
Key is being ready. We have stuff on our website as guides for people who are looking, especially company directors, business owners, sole traders. As long as you've got your affairs in order, i.e. tax affairs in order, it's a simple case of will provide us with the following list of information. It's all information that you either will have or you can get at very short notice. So lenders won't treat you any differently. They just want to see sustainable income.
Okay. You mentioned having a sort of credit report as well. Can I still qualify for a mortgage if I have a low credit score or irregular income?
Definitely. Irregular incomes, contractors are classic example of irregular income. Very much so. In fact, there are mortgage products out there designed for people like that. Okay. So it certainly shouldn't put anybody off. In terms of low credit score, there's credit score and there's credit rating. Everybody's got an app on their phone today, whether it's Credit Karma or ClearScore or whomever, and they'll give you really helpful pieces of information on how to improve things. Ultimately, when we're going for a mortgage, we'd like to see what all the bureaus say, so we can see credit conduct. And if you have what you feel is bad credit, well, let's say exactly how bad it truly is. It generally is never as bad as you think. However, if there are little blips there, like a default or county court judgment or sequence of missed payments, something we need to know up front. If we know that up front, we can take care of it. We do have a suite of very, very good lenders who can deal with that.
Okay. We kind of touched on this with our first question, but do you foresee mortgage rates lowering within the next 5 years, or do you think they'll continue to rise?
Bit of a crystal ball question.
Yes.
I read the same newspapers as everybody else, and listen to the same podcasts and everything else. Yes, we're given a sort of insider news in the industry, but it's just industry news. I would think it's impossible to make a future decision based on a question like that today. Rates have gone up. The markets do not believe they're going to go up any higher, and the International Monetary Fund published yesterday that rates will return to cheaper levels again in the future. So truthfully, who knows? But I certainly wouldn't let it put me off making decisions now.
Yeah. I guess the media has kind of heavily influenced that, hasn't it?
Definitely, because it sensationalized the whole thing. It sells advertising in newspapers and drives us all mad. It's not strictly true.
Yeah.
But they do what they do best, and we'll do what we do best.
Yeah, we've definitely felt that in terms of our clients worried that have properties that we're managing. They've worried about renewing their mortgage and thinking, should I sell now? Is now a good time to sell? And it's a lot of noise from the media, isn't it? So that's good to hear from your side.
people think about what's right for them. That question I've heard as well, should I sell or should I remortgage? Well, what have you got the property for? Why did you buy it in the first place?
Yeah.
Is it part of your long-term plan? Will you retire in it? Would you rent it out? Would you let the kids live in it when they go to university? All those things matter an awful lot more than any scaremonger or any news channel.
Yeah, exactly. So on that, we had someone submit this question. I'm on a fixed rate mortgage which ends next year. Do you suggest I fix it again or go variable?
Right. Very common question. I can't give any advice on that. Obviously, we need to meet the person and find out about the circumstances and then get a recommendation from there. In straight answer to the question, I would encourage the person to say, well, what does the next 5 years of my life look like? And if they're going to stay in the property or if they have a very fixed income, well, that all sort of points to fixing your costs.
Yeah.
But if they have other ideas, perhaps they may be moving away, they may be renting the property out, and that needs another conversation.
Yeah.
So seek out an advisor. Again, sorry to say the same thing, but seek out an advisor, have the conversation, and get some professional advice on that.
Okay. And another question has been, I already have a mortgage in place, but I'm considering a second property. How much of a deposit will I need for a second home, and how does that process work?
Okay. Lots of people do this, and you can get anywhere between 10 to 20% deposits, depending on the lender, for a second home mortgage. One thing that's very important to point out is that whenever a lender is going through an application and looking at affordability, they're going to want to see that you're able to afford both properties, both mortgages, with all their costs on a monthly basis. So they'll stress test that on a full repayment basis. There would be no interest only option really for that. So that's, again, sitting with an advisor working through income and expenditure and just ensuring that no matter what sort of life throws at you, that you still have got the ability to service two mortgages.
And so say the second property is for a buy-to-let property, I take it that process would be pretty much the same, and having that rental value of the second property is key.
Yeah,
for that.
If the property is not to be a second home or the holiday home is to be a buy-to-let, then yes, there are interest-only options there, but that is, as you said, it's all to do with the rental income. So we need to figure out on day one, if a property is bringing in £1,400 a month rent, how much will that actually generate in terms of a maximum loan? And then we will work backwards to see what's comfortable and affordable for you.
Okay, that's good to know. And that concludes us on our questions submitted. And thank you very much for coming in.
Thanks for having me.
It's actually been very insightful, and hopefully our viewers have found that very interesting too, and we've answered some of the questions. Thank you.
Cheers.